Oh no, it's tax season. Am I going to have to pay more taxes than I should? Now, the reality is, what we're talking about now is last year. But what if looking forward, I could help to show you how to reduce your tax exposure so this time next year you aren't paying as much? In this video, I want to share with you 6 specific areas that could help you to potentially reduce that tax exposure. Hi, my name is Mark Singer, and if you're interested, please hit the subscribe button and hit the notifications bell so you're alerted to when we post new and great videos about retirement income, and Social Security. Now, if you're my age or around there, you may remember when you were in elementary school, they sent those report cards home, right? And oh my, I was a horrible student. All right, so anytime those report cards came, you had to tear those perforations from the side of the envelope and wait to see what those grades were. I knew they'd be awful, right? Or if you're a little bit younger and we recall, or when our kids were applying for college, and the packages would come in and we'd wait to see whether they were accepted or rejected. Was it a thick package or a thin package? It's sort of like going to the accountant now. It's tax season and they're going to deliver to us that information. And are we okay? Did we pay enough in taxes for last year? Do we owe a big number because we didn't anticipate some particular event or didn't have a big enough withholding? Well, most accountants are what I call historians, okay? What that means is you go into their office sometime before April 15th, or if you're on extension later, and they tell you what happened last year. Very few are really proactive. And I want to take that role for you right now and be proactive and try to share with you some of those tips looking forward. I can't do anything for what happened last year, but maybe we can help you looking forward to reduce some of that tax exposure. So let's get started. So as you know, if you've been watching my channel, we specialize in retirement, those who are transitioning into or through. And I've said it over and over again, cash is king when you go into retirement. And the most important part of the planning is to develop what we call the income faucet. In other words, identify what income you need to come in, identify some of the sources that are coming in, and then figure out from which of your buckets in your part-time work or your retirement accounts or your personal or joint accounts, where the income has to come from, not only to satisfy your income needs, but to reduce the impact of taxes on an annual basis. If you properly identify within the income faucet where the money should be coming from, you'll do all you can to lower that tax exposure. The goal isn't to pay no taxes. The goal is to get as much income as I need to pursue my goals and pay as little tax as possible. So again, given that I live in the world of retirement for our clients, one of the big issues that we find for those who are retiring early is a little known IRS code called Section 72T. So let's say that you're retiring at the age of 54. Things went well for you, you hit your retirement number, you're ready. You're ready to get on to whatever this next chapter of life is. And you've got this 401k that maybe you've just rolled into your own self-directed IRA. All right? But now you need income. The problem is if you start to take money early out of a retirement plan, like a 401k or an IRA, not only do you pay taxes on the amount that comes out, but you also pay an early withdrawal penalty. And this little known IRS code can help you to avoid that penalty. So here's the deal. what you have to do is take out equal amounts of money according to the actuarial tables that the IRS provides over at least a 5-year period or until you reach age 59 and a half. And in that way, you will eliminate the 10% penalty. And that, again, that can be pretty hefty depending upon how large that IRA is, how much you need to take out per the Section 72T rules. So if you're 55, you must take it out for a period of 5 years. So in that instance, you'll have to take it out till age 60, which is just beyond 59 and a half. If you're 54, you'll have to take it out to age 59 and a half. That's the number you have to reach, or 5 years. So again, you can talk to your accountant or your financial advisor if you've retired early with a large sum, right? And you need to get income from that earlier than 59 and a half. That is one way to save 10%, that early withdrawal penalty, which could accumulate into a lot of money over those 5 years. The second item that I want to talk to you about is the area of Social Security. And again, on this channel, I've talked about this a lot. If you want to take a look at some of the other videos in terms of how to reduce your taxes when choosing your Social Security benefit, please go ahead. But I want to just focus in on really two concepts right now. First, if you were to take Social Security before your full retirement age and you are still working, you will not only have those Social Security benefits taxed and the income tax, but you'll also have a withholding from Social Security. It could be costly at a time when you really need that money. Of course you need it because you're taking it early, right? Before your full retirement age. So be very careful when you're looking at Social Security and you think you need that money before full retirement age and you're still working. Run the numbers before you make that choice. I think you may find out it might not be the right decision. The other is globally with regards to Social Security. And this gets back to the income faucet. It's not just a decision isolated, when should I take Social Security? If you do it right, you may be able to increase upwards of $200,000 to $250,000 over your household lifetime income if you make the right choice for you and your spouse. But you have to take in a number of different considerations. Health, when is retirement? What kind of income do you need, right? What is the difference in age between the two of you? Are you better off to defer till age 70 or sometime beyond full retirement age? And again, when it comes to your retirement bucket, you must account for the required minimum distributions, which now start at age 72. And how do you coordinate the different time frames? When I think of the income faucet, we do think in terms of time frames. We do think, let's say you retire at age 65, 66, 67. That first stage of the income faucet really is from when you retire to age 72. How do you maximize your income? Where do you get it from properly so you get what you need but lower your taxes? Specific to Social Security, you have to go into the calculators. We've got 7 of them for our clients, and actually come up with the number, the year for each of you as to when is the optimal time to make that claim. Because again, the wrong timing could mean not enough income and potentially too much in the way of taxes that you'll have to be paying looking forward. So the big question is, are you prepared for retirement? So we've developed a quiz for you in our banner. It's a quick 2-minute quiz, and once you do it, we will score it for you and send you your results to show you which of the 3 stages of retirement preparedness you are in. And in addition to that, because I really want to give it to you, I just completed my 4th book, and I will share with you not only the first chapter of that book, but also a couple of worksheets that will give you a little bit more clarity in terms of what you need to do so you're prepared for your retirement. Go to the quiz, take it. You'll get some good information. So the third item I want to talk about is required minimum distributions. Now, last year, the age at which you had to start taking money out was 70 and a half. That was pushed back a year and a half to age 72, which is good because most of my clients don't really need the money coming out of the required minimum distribution, but they have to take it out because the government wants to take taxes from it because it's grown tax deferred all of this time. But the question is, from a planning perspective, based on what your income needs are, again, getting back to that income faucet, are you better off to start taking distributions from your IRA now versus taking it at age 72? Remember I said the first stage of that income faucet is from, let's call it now, to age 72. Well, we have to take a look at it separately from when we reach age 72 because there's a different component now. It's the distribution from your retirement buckets. So we have to look at where the income comes from separately. It may be, depending upon the construct of your portfolio, whether part of it is retirement, part of it is personal or joint accounts, depending upon what kind of pensions or incomes you have coming in, and when you chose to take Social Security, it may be the better way for you to start taking distributions from your IRAs before 72, which may reduce taxes later on. Now, this is something you really have to talk to an advisor to do the planning and to generate that income faucet, to understand and do the what if scenario for plan A and what if scenario for plan B and come up with a strategy that works for you. But I think you really need to take a look at whether or not it does make sense for you to make those distributions from your IRAs earlier than age 72. Now, the fourth item, again, is another topic we've discussed on this channel, and you can take a look at some of the videos we've done on it. It's with regards to the Roth IRAs. Now, the great thing about Roths are there are no required minimum distributions, and there's no taxes coming out if you were the original owner of that Roth IRA. Those are great reasons to have a Roth. But the question is, if you don't have one now, should we be converting money and throwing it into a Roth so we can get the benefit later on of tax-deferred income, tax-free out, and no required minimum distributions? Sort of puts you a little bit more in control of that income faucet. But here's the catch. Always a catch, right? If you convert, let's say, $100,000 from your regular IRA into a Roth IRA now, and let's say you're closing in on retirement, you're 65 years old, you're going to be adding $100,000 to your income for this year. That's the amount that you converted, and you'll pay taxes on that amount. Let's say, you owe $25,000 on that amount. So you converted 100, but you need $25,000 extra to take care of the taxes owed as a result of that conversion. Does that make sense when you're in your 60s? To be honest with you, for most of us, it really doesn't, unless your estate is large enough that you can carve out a portion for the benefit of your heirs where they could take advantage of that particular account. But if you're really closing in on retirement, you really need to run the numbers. Now, we do believe the tax rates are at a lower rate now than they will be later. So you may take that into account with your calculations, and it may be that by spending the $25,000 now, that when you want to take the money out of the Roth, say in 10 years, you would have paid a higher tax bracket at that point, and therefore it might make sense to convert to the Roth now. Again, go to your advisor. And what I really feel like, however, the Roth is much better for those who are in their 30s, 40s, even 50s to either start to contribute to it or to convert some money over, because then you have more time to overcome that tax hit. But I do think the Roth is a serious consideration, specifically for those who are approaching retirement and have to think about required minimum distributions. It may be a vehicle you may want to take a look at to reduce the impact of future taxes. So as I go into this next item, we'll call it your personal or taxable or joint accounts. Here's a scenario for you I've run into numbers of times. So somebody comes into my office and they've got a CD or a bond fund or some fund or something that's paying a dividend or interest. And because they're not using the money, because they're not taking the money, oftentimes they think they're not paying taxes on it. It just gets rolled over. But that's not the case. Whether you touch it or not, you're taxed on it. And that goes the same for if you own some sort of fund that is paying out capital gains at the end of the year. If you're not touching that money and you just reinvest it, you're still paying taxes on it. So one of the things you should really take a look at, particularly if you have retirement accounts and personal or taxable accounts, is what kind of investments should be owned in the retirement or tax-deferred accounts, and what type of investments should be owned in the personable or taxable accounts. Because getting back to the income faucet, again, depending upon what your needs are and whether or not you need income from your portfolio, and depending upon what age you are, have you hit required minimum distribution or not, bond or yield type of investments may or may not be better off in your retirement account to defer the taxes on those dividends or capital gains. But I can't give you the answer right now, that old saying, it all depends, because I don't know all the information. If you sit down again with an advisor, run the income faucet, and take a look specifically at your two different types of portfolios, depending upon your income needs, you may find that by reallocating the monies between these two different buckets, you could reduce your taxes. So we're at the final one. It's the sixth one. And this deals with charitable giving. And those particularly who are at or beyond required minimum distribution age. So here's the deal. Let's say you have a charitable intent and you want to give to your college. You're an alumnus of a particular university and it's been a long time and you want to get them some money. And you've got money coming out or being forced out of your IRA as a result of the required minimum distribution. But you don't necessarily need that money. Here is a wonderful opportunity for you to take the distribution and have it go directly to the charity. There's a specific IRS code to take a look at this. You should talk to your accountant or your financial advisor. But it's a wonderful way because, again, the monies that come out of your required minimum distribution, if you touch it, you take it, you pay taxes. But if you direct it as a charitable gift directly to the university, you satisfy the required minimum distribution rule, but you don't have to pay taxes on the amount because it goes as a charitable donation. Interesting, right? Take a look at that, particularly if you're of required minimum distribution age. So here's the answer to the question. Can you reduce your taxes? Absolutely. But it has to be when you look at the whole picture. Develop that income faucet. Figure out what income you need, where it should be coming from, how to hold those investments, and take advantage of the different strategies that are available to you in the IRS code. And you may find yourself that next year, when you open that envelope and they tell you how much you owe for taxes, then it may be less than what you had paid the year before. I hope this has been useful for you, and I really do hope you enjoy the retirement journey.